Hello viewers, welcome back to our YouTube channel, KC Accountancy Education Center. Today we want to kickstart our new course of Public Finance Management. It's actually Public Sector Financial Management. Public Finance Management, or what we call the Public Sector Financial Management. This is paper. It is a CPA paper. It is a CPA paper of level 3. It is a level 3. Level 3 is paper 13. It's now paper 13. Previously, it was called Public Sector. It was paper 14 previously, before they changed the syllabus. So we are starting on our series of Public Finance Management, and this is a paper on level 3, as I said, as per our new syllabus of 2023. That is the new syllabus, and I think it would be very good if at all we look at what we are going to cover in terms of the course syllabus, given the fact that we had some major changes in the syllabus. The syllabus of Public Finance Management, they made some changes because as we moved from the previous syllabus to the new syllabus, they made some new changes. So before we embark on our journey for this series of Public Finance Management, even the name was changed. So let's now look at the new syllabus of this paper, Public Finance Management. So if you try to look at of course, the syllabus, the detailed syllabus, you can pick it from the detailed syllabus of the year 2023. Specifically, we can look at, you can check our website, you can also check our Telegram channel to be able to download the syllabus. You can check out we have 2 websites and a Telegram channel. You can put in cafeocharles.com in Google. Even if you just search for Cafe Charles, you go in Google, you type in Cafe Charles, you look at that website, or we can use our KC Accountancy Education Center.cafeocharles.com. These are our 2 syllabuses where we can actually go to and we check. We can we can be able to get the materials, and we'll be able to access the question papers and other materials that are relevant to different courses. This is our marketplace. This one, number 2, for the school, KC Accountancy Education Center. This is the personal. It's just a subdomain. This is the main website, but this one is just a subdomain of this. The main domain is my own name, personal. So you can go there to be able to download the course syllabuses for different papers, either on level 1, level 2, level 3, and so on, plus other information that you'll be able to access from that point. So once you are done with that, we want to go through, but I'm going to be writing up some few things that we are going to be looking at. Now, as we try to look at the detailed syllabus of this paper, the public finance management, we can see that we have quite a number of topics, and I think there are about 17 topics that we will actually cover. And of course, we will see from the introduction to public sector or to public finance management. We shall have, of course, to understand what public sector is all about. What is public sector? Before we look at the accounting of the public sector, we need to first understand what public sector is all about. But as I said before, they made some changes in the syllabus before they introduced the new syllabus. This paper was one of the courses that were affected by the changes or by the previous syllabus. It was affected in the sense that previously they used to call it public sector accounting and reporting. And by then it was paper 14. But now they changed it to what we call public finance management. And now it is paper 13. So it was changed from the public sector accounting and reporting to public finance management. So they just switched from accounting. They only switched from accounting and reporting, and they put more of what we call financial management. But this financial management is not within the private sector, it is within the public sector. So it is more or less into the financial management part of it than the accounting and the reporting of the different things that are being done in the public sector. And if you try to look at the two course outlines or the details of these two papers from the previous paper 14 to the new paper 13, if you try to look at the details, of course you will see that there are few things that were changed, but these few things, these are vital things that they changed into this course outline. If at all you try to look at those two course details, and I'll try as much as possible to be able to elaborate some of the to talk about some of the things that were in the previous syllabus that were removed in the new syllabus. And the implication, of course, there are some of the things that were removed, but we shall find ourselves having to study them because we will need them as we are doing some of the things. And I will be able to talk about some of the things that were changed in this introduction. So this is just part 1 of the introduction, but as by the time we finish the introductory part of it, we shall be able to understand what are the things that were changed from the previous paper 14 to the new paper 13. Therefore, as I was saying, we have to define what we call public sector. So we have to know how it differs from the private sector, because we know that there are two sectors. We have the public and then the private. Of course, we also have the other non-profit. But most of the things that we are focusing on is the public. This is something that is a bit different from what we've been looking at. So we want to see how the public sector differs from the private sector. And maybe, of course, the other civil sector, all the what we call the non-profit making organizations, you will find that they are somehow similar to these public. They are not public sector, but the way they operate is a little bit similar to that of the public sector. So those are the three sectors that we have: the private sector, the public sector, and then the civil society sector, or the non-profit making organizations. But also, as I said, we will be looking at the changes that were made in that old syllabus of paper 14 vis-a-vis the things that we need to look at as far as paper 13 is concerned. But for those who did paper 14, because we have the reason as why we are trying to get to the point of what has been changed from the usual things that we knew to the new syllabus is because we have those maybe that did some papers but they didn't pass. Maybe they have taken some time without sitting exams, and maybe they had studied this old paper 14. So for those who did paper 14 previously and maybe they didn't pass, or for those who studied but they didn't do exams, you need to see, you need to know what are the things that really changed from the real things that you had studied earlier. So, but one thing that you need to understand, for those that who had studied this paper 14, of course, you don't need to know much of what has been changed. For those who never studied, you don't need to know what really changed, because you are not going to be doing the other previous papers. But for those who had done it, you need to know what has changed so that you can be able to leave some information outside. You focus on the things that we are going to be looking at in this new paper. Because if you are just new to this public finance management and you need to really go deep into what changed, of course, for those who didn't attempt or who didn't study paper 14, you'll be maybe, because when you try to look at some of the past papers, you'll find that some standards were set, and this time around we are not going to be having those numbers. But once you look at the past paper numbers, you'll be able to see what has been examined. So it's something you can pick. You don't pick much interest in it because it will get you confused. Just understand that the key things that really changed and what you focus on the new things that we are going to be talking about. So for those that are just doing paper 13 for the first time, you have never had maybe any lecture on paper 14, you have no problem. Just stick with me. We shall be able to go through the different aspects. But those who had studied on paper 14 and those, because there are those who are not studying, but they are watching. But for those maybe who had studied paper 14 and they are just reminding themselves, you just need to know the key things that were really changed so that you can be able to reflect on what has been included and those that have been excluded from the new syllabus. Also, I will be highlighting some of the new things that came into this new syllabus and what was removed, because what changed is not so much, although it is something that is significant, about 40%, 40 or 35%, or maybe 45% was changed from the previous paper 14, and it is very different from what we had from that paper 14. Because if you try to look at what are some of the things that they removed in the previous paper 14, we used to have very many ipsases. We shall learn what ipsases are, but we had very many of them that were in that paper 14, because paper 14 was basically on accounting and reporting. That's why there were many standards. These ipsases, these are the standards. There were many standards. Some were removed and others were retained. So we shall be covering those that were remained, that they retained, and we shall also look at some of those that were excluded or were removed from the syllabus. So in our introduction, it's all about knowing what public sector is all about. We need to understand what public sector financial management is all about. At first, you need to understand what a private sector is. 2, you need to understand public sector financial management. What is it? So once you understand what public sector financial management is all about, but what we know is that it borrows a little from what we studied in financial management, because it is more of a financial management, how we manage finances, but from the point of the public sectors. The other one, we looked at financial management, but from the point of private sectors, where we had shareholders and all that, where we had owners, where we had limited companies and public limited companies. But here we want to look at the private sector, the government. It is more from the state-owned enterprises and so on. So we need to understand what public sector is all about, and we also need to understand the public sector financial management, because we left the point of public sector accounting and reporting, that was paper 14, to more so, or to dive in deeper into the public sector financial management. So that's what of course, it borrows, as I said, it borrows some little knowledge from what we know in financial management, what we know in financial accounting, and also what we know from the financial reporting, because we are going to be talking about some standards. By the time you are doing this paper, you must have done financial reporting on level 2 or financial management on level 2. So we are borrowing some information, even the financial accounting on level 1. We are borrowing some information from some of those papers that we did. So some of the things that we are going to be borrowing are because we also have users, even here in public sector, we are going to be having users of financial statements of the private sector. Once we have users of these financial statements of these public sectors, we also have to look at the information that is needed, or the information needs. We have users of these public sector financial statements, but what do they need from these financial statements? That is the information needs of the different users. And we shall also need to cover other aspects from within the introductory point of view. So we need to understand just a little bit of what a public sector is and public sector financial management. Also, we shall have to understand the levels or the categories of the public sector entities. Of course, you understand that when you talk about the public sector entities, we know we are talking about the ministries like, let's say, Ministry of Local Government, Ministry of Finance, Ministry of Trade, Ministry of Water, those different ministries, Ministry of Works, Ministry of Internal Affairs. Those are the different ministries that I'm talking about. So we may have the ministries, we may have agencies. Of course, we have agencies and departments. Some of them are just departments. Some of these agencies, we may have DPP, Directorate of Public Prosecution. We have, they are different departments. They are URA, Uganda Revenue Authority. They may be agencies, departments, or authorities. So they are different departments that have been assigned on specific items. We may also have local governments, district local governments. I know everyone knows what a district local government is all about. So we may have, because each district has a local government, we may have the statutory bodies. These are bodies, statutory bodies, these are bodies that have been formed by the Act of Parliament, like the Institute of Certified Public Accountants. If you look at the Institute of Certified Public Accountants website and you look at how it came into existence, you'll find that it's a professional course that came into existence after enacting some laws by the Parliament. So there are very many. We may also have companies that are public in nature, Like if you look at the new vision, if you look at the public universities, and so many other aspects. So we shall have to understand all of these items. But now, the way we are going to understand some of these items is from the academic. We have to make sure that we put, because we all know what are some of these things that we are talking about here. The ministries, the agencies, the local governments, statutory bodies, and others. We all know them. If I talk about URA, someone knows. But we need to put it in the context of the academic environment. We need to understand if you are being asked on it, what are you going to write? So we are going to put them into the context of the academic environment. So that's the part that we'll take into the introductory part. It will be able to give us what we need to know. But the other thing that will also be within the introduction, the introduction will be the regulatory and institutional framework. The regulatory and institutional framework. You know, just like the way we can look at the conceptual framework, it is just, these are just guidelines, the regulatory and the institutional framework that are governing those different organizations. So, for those regulatory and the institutional framework, especially for those who did paper 14, because as I said, I have to be able to elaborate some of the few things. The introduction, for those who did paper 14, the introduction is still the same. The introduction of paper 14, the previously paper 14, is still the same as the introduction for paper 13. The introduction is still the same. You have to look at the public sector. You have to look at the public sector, maybe financial management. Of course, the other side, you may be looking at the accounting. As you account and you report, you are also trying to manage. So, the introduction is the same for both paper 13 and paper 14. So nothing much has really changed from the introduction. But as I said, although they included in something, because remember in paper 14, it wasn't so much into looking at the financial management aspect. Because paper 14, as I said, was all about public sector accounting and reporting. And now the paper 13 is just public sector financial management, meaning we are so much into the financial management bit of the public sector, other than the accounting and the reporting bit. So that's one of the significant change within the introduction. But as I said, the introduction did not change so much, apart from just introducing in the aspect of public financial management. So the regulatory framework. If you are to look at the regulatory and institutional framework, we are going to look at that in the next video. This is just part 1 of the introduction to public sector financial management. So let's meet in the next video as we are talking about the regulatory and institutional framework. We want to understand what it is. Remember, we are still introducing the topic. We are still looking at the different things that we are going to go with, like the the detailed analysis of the course outline, so that we see what is there, what has been removed, to be able to put you in a context of knowing what we are going to cover. So let's meet in the next video as we are talking about the regulatory and institutional framework. Regulatory and institutional framework. The regulatory and institutional framework. Now, as we spoke in the previous video, we had looked at the introduction part 1, and this is now our introduction part 2. And here I want to look at the regulatory and institutional framework as part of our introduction to public sector financial management. Now, regulatory and institutional framework, we shall be looking at the framework. We shall be looking at the framework that guides the public sector financial management, that guides the public financial management. The framework that guides public sector financial management, and also its environment. We shall also look at and its environment within which public financial management is done. Its environment within which public sector financial management is done. Within which public financial management is done. So, of course, this is the public sector financial management, and of course this includes the legal framework. It includes the legal framework. It includes the legal framework. Of course, within the legal framework, we have the laws, we have the policies, and the regulations. Of course, the laws and the policies, those are the regulations that guide the public financial management. Of course, within the laws, policies that govern or that guide the public financial management, we shall look at a number of different laws and regulations. Of course, I can mention some of them right here, but we shall go deeper into the different laws, the different regulations that are available, that are guiding us in managing the finances within the public sector. For example, we can talk about what we call the we have the Public Finance or the Public Financial Management Act. Of course, of 2015. Public Financial Management Act 2015, which actually makes the overall guide of public management. This one does the overall guide of public financial management. And you must know that whenever you mention an act, there is also what we call a regulation. Once you mention an act, it means there is a regulation. So we have a Public Financial Management Act 2015, but that same law, you expect for it to have a regulation. An act may be brief, but a regulation is what explains, it gives the detailed analysis of what the law is actually talking about. So the regulation, because an act is a little bit brief, as I said, but the regulation gives details, or it expands the act, meaning that the regulations puts the act into practice, and it guides on every bit of that act. So that's a regulation. An act is very brief, but the regulation gives you the practical aspect of every bit of the law. So there are certain things that the law may not cover, but you will find them being covered in the regulation. And at the same time, you may find that in some regulations, some regulations may not cover much of the things that are supposed to be covered. Of course, once the act is there, the regulation gives you the practice of every bit of the things that are supposed to be done according to that act. Then, once certain things are not detailed, or once certain things are missing within the regulation, then you'll find that in the manuals. They are called manuals. We shall cover also manuals in details. We shall also look at the different manuals that we have. But also, as I told you, of course, the regulation, this is Public Finance Management Act of 2015. Then the regulation is actually the Public Finance Management, Financial Management Regulation. This is of 2016. Of course, we have other acts. One of the acts that we may be having, that one may be number one. The other act that we may be having, we shall look at the Local Government Act. Local Government Act of 2003. 2003. Of course, we also have the Local Government Act. Because we are basically trying to look at the financial management point of view, we shall look at also the local government, permit me to abbreviate government like that, local government finance and accounting manual. Let that be the accounting. We have also manuals, but as I said, once you see the act, there is a regulation. This is local government finance and accounting regulation. Of course, this is of 2004, 2004. So these two are related. Once you see the act, it means the regulation will come into actually. This is the regulation. This is the act. They are related. So we shall also cover what we call the local government finance and accounting manuals. As I told you, once certain things are not clarified by the regulation, you'll find them in manuals. And the one for local government, we have what we call the local government finance, local government finance and accounting, local government finance and accounting manual. Or you can call it local government financial and accounting manual. So that's, of course, when it comes to local government, we have also these other policy manuals. We have also policy manuals. We have also the policy manuals. So there are very many manuals, as we shall see once we start looking at what manuals are. But as I said, for local government, of course, you will see that all of it, all this information, all these regulations, all these acts, all these policies are helping us to be able to manage finance within the local governments. Remember, we said local governments are actually public sector entities. So, the Local Government Act 2003, the Local Government Finance and Accounting Regulation 2004, and then the Local Government Finance and Accounting Manuals, plus the policy manuals. Those are the ones that are helping us to be able to know how to manage the finances of local governments. So that's all for the local governments. But as I said, there are very many acts. There are some acts we are going to be dealing with that are actually managing part of some of the activities that have been done within these public sector entities. There are some acts that are going to be dealing with what we call the procurement and disposal. There is an act that is dealing specifically on that. It's called PPDA. That is Public Procurement and Disposal of Public Assets Act. This is Public Procurement and Disposal of Public Assets. Public Assets Act. This is PPDA. Of course, this one has its related regulation. That is public procurement and disposal of public assets regulation. Public assets regulation. That is the PPDA. It has also its regulation. This one gives you a highlight, what is supposed to be done. Then the other regulation gives you how you are supposed to do that very item that has been talked about in the act. But the good thing with this PPDA, we have a process, because this PPDA has a lot of regulations. There are very many things that are within the public procurement and disposal of public assets. Those government assets, whether they are old cars, whether they want to buy, whether they want to sell, whether they want to get suppliers, whether they want to sell off all the government assets, the process they go through, it has a lot of regulations. We have around 11 regulations for this. Over 11 regulations that are going to be covering what we call the PPDA process. For you to understand this, you'll understand it as a process, not understanding it as just understanding maybe dispose of, let's say for assets of local government. It's a process. Once you want to understand it, you should understand it as a process. You get it in your mind that I'm dealing with a process. It has a starting point and it has an ending point. So that's why we are seeing it has a lot of regulations. So we shall understand the process from the point where we are initiating the process to the point where we are awarding and managing of the contracts of governments and its agencies. How do we manage the contracts that the government has, maybe with the public or with its related agencies? And that process is governed by very many regulations, as I've talked about. For example, some of the regulations that we have that are trying to manage this process, we have that deals with the evaluation, the PPDA evaluation regulation. We have the one that deals with the administration of those contracts, PPDA administration. Let me just call it admin regulation. We have the one that deals with the contracts regulation, PPDA contracting regulation. We have the one that does the costing, the cost accounting. We have where you try to look at the costing mechanism, the cost accounting mechanism of how do we attach certain values on a given contracts. So there are very many, and we are going to cover these. Of course, we are not going to cover everything, but we will pick what is relevant, even though our syllabus much as it appears to be a little bit detailed when it comes to the PPDA process, but we shall pick what's relevant, because as I said, it has a lot of things that we can't cover, but we shall pick what is relevant, because as I said, our syllabus for this tries to look at it as if it is a very detailed. It appears to be so detailed, but it's not as detailed as it is once it comes to the exam. So it's a little bit brief once you look at once you look at it from the examination perspective. So sometimes we have to go beyond what we may see on the syllabus, because you may see certain things on the syllabus, but once you look at the past paper questions, you try to find that it is actually digging deeper into what the standard or what the syllabus is actually portraying. So certain things we shall go deeper, other things we shall ignore. So we pick out things that are going to be relevant to our syllabus. So we shall be following our syllabus and also borrowing a little from what we see what has been happening in the previous examinations, and we try to leverage on what we have, because as I said, it is very wide, but you need to know from the beginning that it is a process. Once you understand it as a process, it will be very easy for you than just picking out key things within the process. So we shall go deep into some of these regulations and acts as we progress, specifically for let's say the PPDA, because we really need to internalize it. Therefore, I think those acts or those regulations are enough for now. But you have to understand that these acts are quite many. They are very many in numbers. If you look at the local government, if you look at the public finance and accounting, if you look at these PPDA, the acts are very many. But remember, there are those that we haven't even spoke about, like the Constitution itself. The Constitution of the Republic of Uganda. Of course, the Constitution of the Republic of Uganda. Of course, this is of 1995. We also they are also the Accountancies Act. Of course, this is of 2013. And of course, there are many more, as we shall keep on seeing. We shall be seeing them once we try to reach at some of those different aspects. So I was trying to throw more lights on the regulatory framework. I was basically looking at the regulatory framework, where we picked out the legal aspect, and we tried to look at some of those acts and the regulations. So we've been looking at the legal framework. But remember, our topic has been the regulatory and institutional framework. So we may have the whole act, but we may have the institution itself having the different things that they are following that are institutionally, that are supposed to be followed by the institution, because these institutions are going to be within a given sector. They may be in communication, they may be in education. There are certain things that are supposed to be followed in education that is different from what the media people will actually follow. So that's why we are looking at, we've looked at the whole thing, the acts that are governing the entire thing, like the constitution. Everything is supposed to be below that. So we've looked at those, the regulatory framework, and this was all about laws that govern the public finance management. We are not picking out the entire laws. We are picking out laws that are in relation to public financial management. Something that is outside that, we don't really focus on it. But now let's look at what we call the institutional framework. The institutional framework, and here we shall be looking at the institutions. What are some of the institutions that are responsible for ensuring that public funds are managed well? Here we are basically looking at the institutions responsible for managing public funds. Institutions responsible for managing public funds. What are these institutions that are responsible for managing public funds? These are going to be the institutions that are going to be responsible to see that the money, the public funds, are managed well. What are these institutions? These institutions, they are also going to be following the other laws. They are the ones that are going to help them manage the resources of the public. And these institutions, we are looking at the key players in the public. Of course, we need to know the key players in the public finance management, public financial management. And of course, these may be like in terms of offices, they may be authorities, they may be agencies that are going to be monitoring the operations of these other entities. So these may be offices, like offices of the accountant general, offices of the accountant general, offices of the auditor general, and also the internal offices of the internal auditor general, We shall look at the laws and powers of these entities. What are they supposed to be doing? We have also offices of the accounting officers, or we can call them accounting officers, offices of the accounting officers. We shall look at some of them, the accounting officers of the different public entities, where we shall later learn that in these public entities, they are already, they call them votes. They call them votes. Not these votes we are casting, but they are called votes. We shall understand what a votes are, but just know any entity that receives money from the consolidated fund is called a vote. It has an appropriation from the consolidated fund or from the treasury. We can have the secretary to the treasury, the offices of the, even these, the IGG. So they also do such activities to make sure that the public funds are managed well. So every entity that gets money or that gets funding from the consolidated fund is called a vote, and each vote is managed by at least an accounting officer. They call them accounting officer. Those are, if you go to ministries, they call them permanent secretaries. If you go to local government, they are the cow. They are the ones that are accountable for that very vote. So these accounting officers, though they have different titles depending on where they work, but in the financial management language, they are called the accounting officers. And those are basically the heads of those entities in regards to public finance management. For example, as I've said, if you look at the ministries, these accounting officers, they are called permanent secretaries. If you look at the district local governments, they are the CAO, chief administrative officer. And if you go to agencies, of course, agencies, we have the executive directors. Those are the accounting officers. For agencies, those are the executive director is going to be the accounting office of that vote. And that's basically the institutional framework. But not forgetting the parliament. And the parliament is the one that has those oversight committees like the COSASE, like the budget committee, the audit committee, the accounting committee. The parliament has those different committees that are actually responsible for managing, for seeing that these operations are actually moving better. So all these branches of the parliament have their powers, and that they have their roles and powers in regards to public financial management. But now you'll understand the public sector management is divided into two, where we are looking at the central government and then we look at the local government. The central government, those are the ministries, departments, agencies. Local governments, we have, I think all of us, we know what local governments are because it's majorly the districts. But within the districts, we have municipalities, we have sub-counties, we have divisions, and others. So as we look at the institutional framework in the central government, we shall also look at the institutional framework in the local government. So, for example, once you look at the Local Government Finance Commission, the District Local Council, the chairman. Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to look at the reporting framework. Now, in the previous video, we talked about the regulatory framework, where we talked about the laws, or the laws or the legal framework, where we talked about the acts, where we talked about the regulations, where we talked about the manuals for the different private sector entities. We also looked at what we call the institutional framework, where we basically looked at the different institutions that are responsible to make sure that public funds or public resources are managed well. We also said that once we look at the institutional framework, we said it is comprising of it is broken into two major institutions. We looked at the central government, and the central government is composing of the ministries, the agencies, and also the local government, which has the different municipalities, sub-counties, town councils, and others. But as we look at the institutional framework in the central government, we shall look at the institutional framework. We shall also look at the institutional framework in the local governments. For example, we shall look at the Local Government Finance Commission, as I said in the previous video. We shall look at the district local council, or the local council, basically the local council chairperson. We shall look at the mayor. We shall look at the people like the chief executive officer, that is the COW. We shall look at the chief finance officer, the town clerk, the town treasury, the chief internal auditor, and the local government council with their roles. So we shall look at their roles, their functions, and the powers. So once you have looked at that as the institutional framework, we want now to focus our attention on the reporting framework. This is still within the introduction to public sector financial management. The reporting framework is now like our topic number 3. The reporting framework is basically comprising of what we call the standards. It has all the standards. Now, this reporting framework is one of the short topics in this paper concerning basically what we call the accounting cycle. We shall look at the accounting cycle. We also have what we call the accounting policies on top of the standards, because the first one is standards. You know, when you're reporting, we have standards. We report based on the standards. The standards here, we call them IPSAS. IPSASs. These are the standards. When we are dealing with private sector, we are looking at ISs or IFRSs. But now these are the standards that we use in the private sector. But when you come to the public sector, we call them IPSASs. IPSAS, it is the full, that is the short form, but it is called the International Public Sector Accounting Standards. Accounting Standards, IPSAS. These IPSASs, they are the ones that are replacing what we normally know as the ISs and the IFRSs in the private sector. And good enough they reduced these standards, because in the previous syllabus of paper 14, we had very many standards, but here they removed some of the standards. Because the reason as why they removed some of the standards is because they are similar to the ISs and IFRSs. In other words, once they remove some standards, it doesn't mean that those standards are not necessary. It is because someone has an idea, a student has an idea about it, and those that they have left, or those that have remained, it means that there is something new for the student to learn. What you have to understand is that IPSASs and ISs, they are the same. They all mean standards. You may find that some standards, some ISs are actually the same as IPSASs in terms of their treatments, but it is just the name that is changing. The other one, we call them International Accounting Standards. This one, they call it International Public Sector Accounting Standards. It's just the name that is changing. So they are somehow related. So some of the standards that were removed is because the student has an idea of what we basically talk about that particular IPSAS. So, because in paper 14, we used to have about 30 standards, but at least for now, they have reduced now. I think we have like 10 standards or IPSASs, 10 standards in this new syllabus of paper 13. But although in practice, when we try to do some numbers, we may actually cover more than 10 standards, because there are some standards that were removed, but their application will be needed in other standards. So we shall find ourselves picking some of the information from that, even though they are not on the syllabus. So even though the standards have been reduced, but when you are practicing, we may cover more than the standards that are within the syllabus. Reason is because some standards cut across. You may find that there is a treatment that is needed in another standard, or there is some information like for instance, there is no way you can talk about PPE and you don't talk about impairment. But once you come to these standards, IPSASs, you may find that the IPSAS for let's say impairment was removed, but they have left you with a standard of PPE. So automatically you'll find yourself studying impairment, because we know assets are going to be impaired, even though the standard is not on the syllabus. So those are some of the things, and I will keep on talking about them as we progress, that this is not on the syllabus, but we are studying it maybe for the sake of getting such and such knowledge. So that's basically what I'm meaning here, that some standards may not actually be on the syllabus, but we may study them. So the example I've given you is, for instance, of course, now if you look at the standard, there is that major standard. Let me also give you the standard itself. We have IPSAS 17. IPSAS 17 is PPE. The other side we call it IS 16, PPE. The treatment is almost the same, but the terminologies are changing because the other one is private sector, this is public sector. So the terminologies are changing. You're also seeing that this is IPSAS, this is IS. So IPSAS 17 PPE, as I said, once you are left with IPSAS 17 PPE, and you find that in the syllabus they have dropped the impairment, they have dropped that IPSAS for impairment. But if you base on the past paper numbers, you'll find that once you see this question that has been examined on PPE, within the information they have given you, they have also brought in things to do with impairment. So you find yourself, even though the standard for impairment has been taken off, you have to go through it because some information is supposed to be used within the PPE standard. So we shall see some of the past paper numbers. You will see that we shall be able to cover impairment even though it was removed, because there is no way you are going to account for PPE without accounting for impairment. So even if the standard for impairment isn't on the syllabus, we cannot leave it out. So we shall be covering a little bit of impairment, something small that will help us to understand better on how to deal with PPE. So we shall look at some of the trial numbers as we progress through. Therefore, we shall be covering some things that are not on the syllabus, some little few things that are going to be outside the syllabus so that we can actually be proactive. We guard something before it happens, because you may actually forget to be prudent. You say this one it is out of syllabus, but you find it in your question. And also, we shall also go through the standard setting process in order to know how these IPSASs are set. That is within the financial reporting framework. So we shall go through the standard setting process and also the conceptual framework. The conceptual framework. And this conceptual framework for IPSASs is not different from the conceptual framework for ISs and the IFRSs. They are the same, because there are some few things that vary, but they are very similar, because the major differences within the conceptual framework of IPSASs and the conceptual framework of ISs and IFRSs is basically in the terminologies, the terms that are being used. That will be the only difference, but the rest may not change, as we shall see once we go to some of these IPSASs or some of these standards. Now, one thing that you need to understand is the fact that in paper 13, this public sector finance management, we are going to look at little things on standards, but we shall detail so much on other work, because we are going to have very few standards, but we have a lot of information that is not on standards. We have a lot of information that is not on the standards. Standards are going to be very few, but we have a lot of work to handle. So, in other words, what's being done currently in public sector, especially public sector of Uganda, because the reason as why they removed, they modified the paper from the public sector accounting and reporting to public sector financial management is, in fact, just to look at how do we manage the finance within the public sector from the point of how do we report, how do we account certain things, and how do we report certain things. But we moved from that to something of managing the funds, because they are basically looking at the current trends. You look at how these enterprises are actually moving, then you try to be, they are trying to be a little bit considerate so that they can let you understand how, because you're not supposed to just know how to account and how to report certain things, but the main focus should be at least on managing the resources, or management of resources within the public sector entities. And that's why we are seeing we are having a lot of theoretical aspects that are not standards. We have very few standards, but we have a lot of information to handle that is not within the standards. Now, as I said, we are going to look at a quite number of topics, and so far we have looked at 3. We've started. This is an introduction, but at least we have started. So, of course, after this, once we look at these IPSASs, we shall be able to cover some other topics. And maybe the major thing is actually once we look at these standards, once you cover all the standards, maybe they wanted to mix up things with the theory and the standards, not necessarily having things to do with just the standards where someone is just going to be knowing how to account, how to report, and someone does only that without putting in the effort of understanding how basically can we manage the resources. Because the reason as why we are managing the resources is because the money that we are using in these public sector entities are coming from our taxes. So it is more of how are we utilizing the resources than just a mere looking at how the resources can be, how certain things can be accounted for, and not focusing on the efficiency utilization of the resources that we have in the public sector. So under these IPSASs, the ones that are still on the syllabus, because we have those IPSASs still on the syllabus. So I want us to look at this in the next video, where we are going to analyze the standards that are within the new syllabus of paper 13. And we look at the old syllabus, we see the standards that were removed from paper 14. So that's what we are going to focus on in the next video. So thank you for watching. Share these videos to your friends and family so that they can be able to get the same information or the same knowledge that you are trying to get from watching these videos. The reporting framework in the previous video. We are going to look at the different IPSASs one by one. We look at those IPSASs that are still on the new syllabus. IPSASs on the new of paper 13. We look at those that were removed, those that are still there, and we'll try to understand what we are going to be covering. Remember, this is still the introduction. We are basically looking at the course outline. We haven't started looking at the notes, but we are basically focusing on the course to be diving into. On the syllabus, we have IPSAS 1. IPSAS 1 is presentation of financial statements. Presentation of financial statements. It is the same like IS1, though, as I said, some of these, it is basically the terminologies that are being used that are going to be differing. So, IPSAS 1 is still on the syllabus. So this is a very similar standard to the, as I said, it is similar to IS1 in the private sector. It is very similar to IS1. And within this standard, there is no difference in the treatment. Within the treatment, once you are, the way we treat things within the IS1 is the same way we treat the terminologies. The only difference is within the terms that are used. Terminologies used are going under the IPSAS 1. They are different. They are the ones that are going to be changing a lot. For example, where you let's say once you talk about, where you talk about retained earnings, where you talk about retained earnings under IS1, here we shall be talking about accumulated surplus. Accumulated surplus. So the retained earnings will be replaced by accumulated surplus that are going to keep on changing. We shall understand why we are changing the names. Because we know that retained earnings, those are profits that we kept on accumulating throughout the period within the private sector. But in public sector, we don't, these companies or these private sector entities that we have, they are not there to make profits. That's why we don't have retained earnings. We have accumulated surplus, where we get the revenues minus the expenses to get either a surplus or a deficit. So it is either surplus that we keep on accumulating, or it is going to be where we got a deficit. So that's the difference. That's the terminologies that we use. The other, this could be number 1. The other, number 2, could be where we have equity. In IS, where we have equity, you will find that when we come to public sector or the IPSASs or IS IPSAS 1, we have what we call the net assets. We have net assets stroke equity. So once you have equity here in the public sector, we call it net asset stock equity, because equity section within the private sector comprises of the shareholders, the share capital that they have been contributed by the shareholders. But here we have the government as the shareholders. Here we don't mainly have shareholders. We don't necessarily have shareholders in public sector. That's why they are calling it net asset stock equity. So it is just, we just have the change of names, but it's ideally the same, because equity is just changing to net assets. Even these statements are going to be changing. The financial statements will be changing to something surplus or deficit. We have been saying within the public sector entities. Even the other major difference, I think the major difference within the IS1 and IPSAS1 is on the formats. The format is the one that causing the major difference. The formats that all the structures of these financial statements, they are very different from the IPSAS and also from the IS. They are very different from the private sector and the public sector entities. Just like as I said, because once you are in the private sector, what you are going to be looking at, these formats are going to be different. The reason is because once you are looking for profit or loss within the private sector, this is private sector. And of course, once we know that the profit and loss, it means this one is going to be an income statement, or what we call a statement of comprehensive incomes. So it will be an income statement or statement of comprehensive income. Or what we call the statement of financial performance. So you are seeing the names that we call within the private sector. So these are some of the names that we call within the private sector. But when you go to the public sector, we call them statement of financial performance. So you see the difference. This side, this one is now in the public sector. Reason is because in the private sector, you are going to be looking at either a profit or a loss. And here in the public sector, for us, we are only looking at a surplus or a deficit. Revenue, is it higher than the expenditures that we have incurred, so that it can arise into a surplus, or we have spent more than the money that we had to give us a deficit. So because we all know that these private sector entities, they don't come into existence to make profit. They don't exist to make profits. So the intention or the objective is not about profits, and it's not basically the intention. It would be unfair for, let's say, a government hospital. Let me not look at those that trade. Let's say it would be unfair for someone to charge you for using maybe a road. Of course, we have some roads where they charge you, but we shall look at that, because there is how we handle that. Even the money that is supposed to be charged should be at least maybe to cover the initial costs that were incurred in the construction, especially if, let's say, the government borrowed money to construct and it has to pay back. Just like the way you look at government schools, they are not supposed to be charging maybe tuition that is higher than that is charged from the private universities. So you find that we are going to be having that kind of deviation, because what they are trying to, the reason that's why they are charging you lower is because they are charging you the cost. They are charging you an amount to cover the costs, maybe the minimum cost that was incurred. But you find most of the roads in Kampala, most of the roads outside Kampala, they are for free. You use them, you don't pay. Even though you pay taxes to make sure that they are there, but they don't, when they come into existence. So that's why we are saying that they don't exist to make profits. So, and most of the times you'll find that it will be actually, because now for you can make a surplus. You can make a surplus. A surplus would mean that there is something like a profit. But once you make a surplus, you must explain, because by the time you ask for money in the budget, there must be expenditure line that is going to consume that money. So you will be asked why the money is still there, yet some of the things that you had budgeted for are not yet done. You'll find yourself explaining why money is still there, yet you requested for it and you have not done what the money is supposed to be used for. For example, I can give you a scenario. You can say that maybe in your budget, let's say a given district, a given local government had a budget of, let's say, 10 billion for a given quarter. Let's say for one quarter they had, just giving an assumption, if let's say you had a budget of 10 billion and you find yourself utilizing only 5 billion, the question is, why did you ask for that money? Or have you made sure that the expenditure items that you put in the budget have been met? Of course, we know scenarios that you may have a budget of 10 billion, but it doesn't mean that they will actually give you the 10 billion. Because once they go into appropriation, you may find that money is not actually there for that quarter. And maybe they promise you we shall add on in the next quarter. Some of the things that are not done, maybe they will be pushed to another quarter, depending on the amount of money. Because you can have a budget of 10 billion, but you find that the ministry has managed maybe to forward maybe like 8 billion. Of course, some of the expenditure line items that are supposed to be for 2 billion are not going to be worked on because money is not there. But if money is there, you require 1 billion was given to you, you must explain why some expenditure line items were not catered for yet the money was sent. So that's why we are saying that these are profits, because even though you have saved the 5 million and you still have it, but you have 5 schools, and at the end of the quarter you have managed maybe to construct 2 schools, and you still have this money on your account, it means that the other 3 schools that are not yet constructed, you've denied the people that would have enjoyed or that would have utilized those schools, because you have not constructed yet the money was there. You must explain why. Is it because maybe the school where you had planned to construct the schools, maybe the land had some conflicts, you had not yet procured the land, maybe you had to construct a given road, but maybe you have not yet compensated the people where the road is going to be passing. So you must find a reason to justify the remainder of the money that you have not utilized. So that's what we are talking about here, that they are not basically here to make profits, but to provide services. Once there is a surplus, we welcome it, but it shouldn't be at the expense of other people. You have denied people money, but the money is still there, but for you want to show your financial statements to actually show a surplus. It doesn't work like that, which is contrary to the private sector, because for private sector, they can give you 1 billion and they expect you to make 2 billion. And once you do that, they will say the person is actually performing well. So that's something that is going to be very important as we look at the objective, because the objective, these objectives are very, very important, and they are very different in both the way they are done under IS1. And they are the same financial statements. They are the ones that we are going to be preparing: the balance sheet, the income statement, and also the statement of changes in equity or net assets, and also the statement of cash flows. So all these will remain the same, although what is going to change are the names. Because the names are going to be changing, we need to know what are the terms that we are going to be using. Instead of saying a balance sheet, we shall be calling it a different thing. We shall go through some of those things. Because maybe just to give you some example, if you look at how we've been talking about in financial reporting, we've been saying that statement of cash flow, but here we call them cash flow statements, which is basically the same, but that's how they are pronounced, or that's how they are going to be written. So we want to go to the next video where we are going to be talking about the IPSAS statements. So that's what we are going to. Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. We now want to push to the next standard, and the next standard is IPSAS. We said we are going to be looking at IPSAS 2, that is cash flow statement. The other side we call it statement of cash flow, but this side we call it cash flow statement. So this is the other standard that is still on the syllabus. Now, we shall cover IPSAS 2, which is now the cash flow statement, and it has no difference from what we already know from our private sector. It is the same. The same way we prepare cash flow statements here is the same way we prepare cash flow statement the other side. But now, for those of you who did paper 14, or who had studied paper 14, of course, you know from there that you were doing IPSAS 1, and we said IPSAS 1 is presentation of financial statement, followed by IPSAS 2. We are doing IPSAS 1 followed by IPSAS 2, and from here we are going to IPSAS 3. IPSAS 3. IPSAS 3 was accounting policies, comma, changes in accounting estimates and errors, the errors. But now, this was, of course, we had this, as I said, we had this. For those who were doing paper 14, we had IPSAS 1, IPSAS 2, and then followed by IPSAS 3, which was accounting policies, comma, changes in accounting estimates and the errors. This was removed from, if you look at now paper 13, this one was removed. IPSAS 3 was removed. And now from here, those from IPSAS 3, for those that were doing paper 14, you were going to, for IPSAS 4. And IPSAS 4, that was the effects of foreign exchange. Effects of foreign exchange or currency, foreign exchange transactions. And this, we know that this one is similar to IS 21, the effects of foreign currency exchange transactions as per the financial reporting. And in the new syllabus, this one in the new syllabus of paper 13, we don't have it. It's not there. So this one is not there. This one was also removed from the syllabus of paper 13. Now, in the new syllabus of paper 13, we have, from IPSAS 4, we go to IPSAS 5. IPSAS 5, and this is what we call borrowing costs. IPSAS 5 is borrowing costs. This is there. And this one is quite different. It has some, it is similar to IS 23. IS 23 borrowing costs. Although it is 80% similar to IS 23, but it has some difference, and maybe that's the reason as why it was maintained in the new syllabus, because of that difference, because that difference is a major difference that we need to understand. So 80% is the same, and there is a very big difference, and that's why that 20% difference is the reason as why it was left on the new syllabus of paper 13. Now, one thing that I want to clarify is that there are other things that were removed from the syllabus. Like we've talked about the IPSAS 4 that was removed. We've talked about IPSAS 3 that was removed from the syllabus. It doesn't mean that these things, they are no longer relevant. But the assumption is that you already know them. Because we said IPSAS 4, the effects of foreign currency transaction is the same as IS 23. So even if you don't study IPSAS 4, as long as you studied IS 21, you know what to do. Even if the question comes, you don't say you never studied, because you already know. So that's the implication. It doesn't mean that these things are actually irrelevant. They are relevant, only that they were removed because they were just a repetition, because they were just changing names, but the rest of the treatments were the same. So you have to be very careful. So they are relevant. The assumption is only that we have an idea of some of those things that we need to do, because those things are similar to ISs and the IFRSs. For example, as we talked about this IPSAS 4 that is similar to IS 21, even the IPSAS 3, the IPSAS 3, which was accounting policies, is the same as IS 8. It is basically the same. So that the assumptions of the examiner is assuming that you know these things. That's why they are not being examined again. But once you see them in the exams, don't say you never studied them, because the assumption is that you went through if you have not done financial reporting, or the assumption is that you have done financial reporting and maybe you have done advanced financial reporting. Now from here, we shall go to, because we have said that this IPSAS 5 is still there, borrowing costs is there, and it is only there because of the other major difference that we have. We shall look at the difference. We also have what we call IPSAS. We go to IPSAS 9. Once you go to IPSAS 9, because from here, someone will say that maybe we have skipped. We don't have any standard that we have skipped. We have just moved from IPSAS 5 to IPSAS 9. There is a reason. The IPSAS 9, because these IPSASs that were in paper 14, like the likes of IPSAS 6, IPSAS 6 was changed to IPSAS 35, and IPSAS 7 and 8 were also changed to IPSAS 9. So these are the ones that gave birth to IPSAS 9. That's why I've just skipped. I've just moved from IPSAS 5 to IPSAS 9, because these two were changed to IPSAS 9. They are the ones that gave birth to IPSAS 9. And IPSAS 6 was changed to IPSAS 35. So we have not skipped any IPSAS so far. These ones were already, the IPSAS 7 and 8 were changed. So the next one that we go to, the IPSAS 7 and IPSAS 8, they did not change them to IPSAS 7, IPSAS 9, no. They changed them to some other IPSASs. So the next one that we have is IPSAS 9. So even in paper 14, IPSAS 9 was the next one. From 5 to IPSAS 9. IPSAS 7 and 8 were changed to something else. IPSAS 6 was changed to 35. So the IPSAS 9 is actually the revenue from exchange, revenue from exchange transactions. Revenue from exchange transactions. We shall understand what are exchange transactions. Exchange transactions, those are transactions where you pay to receive, like once you pay, you receive the equivalent of what you have paid for. Those are the exchange transactions. And these are also similar. This IS 9 is similar to IFRS, a little bit similar to IFRS 15. Although this one, this IPSAS 9, once you look at the terminologies that they used, they are a little bit different from those that have been used in IFRS 15. So the terms, they are very different that we use in the IPSAS 9. And from there, we shall go to the next one. Of course, those that we are doing paper 14, the next one after this IPSAS 9 would be the IPSAS 12. And this IPSAS 12, that was inventory. And this IPSAS 12 inventory is not on the new syllabus because, of course, this is the same as IS2 inventory. They are the same, but this is not on the syllabus, the new syllabus for paper 13. But now, even though this one is not on the syllabus, we are going to study this IPSAS 12. Although it's not on the syllabus, but we have to cover this because once you are going to be preparing financial statements, there is no way you are going to prepare financial statements minus talking about inventory. So it is not on the syllabus, although we shall not cover it in details, but at least we know some of the treatments. But we shall cover the basics that we need, and we shall be able to know how is it different from IS2, because there is no way we are going to fail to use it. There is no way we are going to fail to use this IPSAS 12, especially when you are preparing the statement of financial position. We shall need to cover that IPSAS 12 inventory. The next one, we have IPSAS 14. Although this one is also not on the syllabus of paper 13, this one is also not on the syllabus for paper 13. It's not on the syllabus. IPSAS 14 Of course, this is events. IPSAS 14 is events after the reporting period. You know, we have IS. This IPSAS 14 is similar to IS. It is IS 10. Events after the reporting period. And this one, as I said, it's also not on the new syllabus. So we shall not cover that. We shall not cover because it is very similar to IS 10. And from there, we shall go to IPSAS 17. IPSAS 17. This one is a very common one. IPSAS 17, it is one of the most loved formulas, IPSASs. This is PPE. IPSAS 17 is PPE. It's one of the most loved IPSASs by the examiner. Even if you check those paper 14 papers, you'll see that this standard of IPSAS 17 never missed. And it is also available in the new syllabus. So we have IPSAS 17 PPE. Of course, and sometimes it comes as an individual question, but in most cases, as part of the statement of financial position or the statement of cash flow. Of course, in the other paper, of paper 14, we used to have IPSAS 16, which was investment property. And it's no longer on the new syllabus. IPSAS 16, investment property, is not on the new syllabus. And we shall not cover that. Also, we have IPSAS 19, which is also it's not on the new syllabus. This IPSAS 19 was provisions, and it's no longer available on the new syllabus. We used to have IPSAS 20. We used to have IPSAS 20, which was all about the related parties. Related parties. But it's also not on the new syllabus. It's not available, and we shall not cover it. We also used to have IPSAS 21. IPSAS 21, and that was impairment. They are different. This is impairment, but this is impairment of non-cash generating assets. Impairment of non-cash generating asset. And of course, for this one, I'm not sure why it was removed, because for impairment of non-cash generating assets, we don't have any IS yet that is related to impairment of non-cash generating. The one that we have, the IS that we have, is for cash generating assets. but this is non-cash generating assets. So I don't know why it was removed. Even the IFRSs, we don't have it, because whatever we have in here, we have whatever we have that IS, is it IS 36, the impairment of cash generating assets. Impairment of cash generating assets. But here we are looking at impairment of non-cash generating assets. So you have to be careful so that you don't confuse the two. So much as it is not on the new syllabus, but it is a major standard, because we don't have any standard that we don't have any IS that deals with non-cash generating assets. So we shall study this, because we need to be proactive. We need to be prudent, because now, since we don't have any idea, there is no way we are going to skip it, even if it is not on the syllabus, because once it appears, you will not have anything to do, because you have no idea. You never studied it. So even if that IPSAS 21 is not on the syllabus, we shall have to cover. So it is a major standard, much as it is not on the syllabus, but we shall have to cover it, because we know majority of the assets within the public sector entity, they are non-cash generating assets. So once you don't understand the non-cash generating, because cash generating assets, those are assets that you can use to generate money. But they are assets that you are not going to use to generate money, like let's say a public road. It is a public asset, but you are not going to use it to generate money. So those are the kind of items that we are talking about. So we shall have to cover, because as I told you, you can travel on these public roads minus paying any money, except for the other express, Entebbe Express Highway. But at least most of the roads that we have, most of these other roads that we have, we don't pay. But of course, even those where we pay, like Entebbe Express, very few people who use it, because by the fact that you have to pay, you find some people not actually using it. You just use it when maybe you are supposed to. You don't have any alternative, but if the alternative is there, you find yourself not using it because you're supposed to pay something. But if you look at the money that you are paying vis-a-vis the cost that was injected to construct that road, you look at it. We have a separate standard where we are going to be talking about that kind of, they are called concession arrangements. Shall be talking about some of those stuffs when we reach there. So those are some of the things. Of course, if let's say there are very many assets where you don't actually pay. If you look at within the government, maybe there are very many. If at all you look at maybe the office furniture that is within the ministries, the different ministries, those people, they don't pay for use those furniture for the ministry, from the ministry. So you find yourself not actually paying, but you are using. If let's say maybe a computer, your government facilities, they just use them minus paying. So most of these government entities, the assets that we use as public, they are just the users, they just use them to provide a service, but we don't You don't pay for most of those services. And we are not saying that all the services are going to be free, because someone is going to be wondering, why are we paying tuition to these universities? Because the intention of you paying would be maybe to cover the minimum cost. Because you may find maybe if you try to compare the cost of tuition in those private and then the public. Of course, we know from the private aspect, someone may reduce the tuition to actually attract very many customers, very many students, and in the end ending up making a lot of money. But you find these government universities, they are charging maybe up to a certain amount, even though in practice it may be a little bit different, because it also is situation based, but at least the motive is to provide a service. So we need to know how we are going to account for impairment of those non-cash generating assets. Because we know how to deal with the impairment of cash generating assets, but these assets, they are not generating money, but they suffer the impairment. So how do we treat that? Because we said this IS 16, it looks at assets that are being impaired, but they are cash generating. Because we know if we move from the known aspect to the unknown, we know that if we are dealing with the IS 16, IS 36 impairment of cash generating assets, we know that an asset is going to be impaired if at all the recoverable amount is lower than the recoverable amount is lower than its carrying amount. Then we can say that the asset is now impaired. But we also say that the recoverable amount is the higher, of course, the recoverable amount, we know it is the higher of the value in use, the high of the value in use, and the fair value. The fair value or the net selling price of the asset. And we know that the value in use, for you to get the value in use, of course, you get the present value. The present value of future cash flows. You see, we are seeing cash flows coming in. But now, if you look at assets, if you are looking at the IPSAS 21, these are non-cash generating assets, you are going to be seeing that these assets, they don't actually have these future cash flows, meaning we can't be able to determine the value in use. We don't have the cash flows that we are going to discount so that we can be able to get the present value. Once you can't get the present value, it means even the value in use, you can't compute it. So that is the implication. Now the question is, if we can't get the cash flows that we are going to discount, then we can't determine the value in use of such an asset. And that's basically the role of this IPSAS 21. because for you will not be having, once you don't have the value in use, it means even the recoverable amount is not there. You can't have it. Now of course, we know, as I said, we are going to maintain this even if it is not on the syllabus. It was deleted from the syllabus, but we shall maintain it because we don't want to assume that we know yet we don't know. So from now, FSSBES 21, once you move from FSSBES 21, you'll go to FSSBES 22. And we are going to look at FSSBES 22 in the next video as we proceed to the other FSSBES, as we finalize on the issues, on the standards, or the FSSBES that were included and those that were removed from the syllabus. Not forgetting that we are still on the introduction part, and we are basically looking at, we are trying to analyze the course outline before we start the real presentation. So let's meet in the next video as we are talking about the FSSBES 22 and we finalize these FSSBES for once. We want now to look at the FSSBES 22. We finalize the FSSBES. We've said from FSSBES 21, what comes next is the FSSBES 22. And this one was also retained, and that is presentation of financial information. Presentation of financial information about general government sector, which is quite similar with, this one is quite similar with consolidation. It is quite similar with the consolidation, but a little bit different. And we shall see how do we present the information about the general government sector. The general government sector is what we call the GGS, general government sector. And from there, we used to have FSSBES. From there, we used to have FSSBES 23, which was all about revenues from non-exchange, non-exchange transactions, revenues from non-exchange transactions. And I think we still have this IS-23, revenues from non-exchange transactions, because you realize that in the public sector, most of the transactions in these public sector entities are non-exchange. They are non-exchange in nature, non-exchange transactions. In other words, it's non-exchange in a sense that once you pay money, you don't necessarily get the same amount of service or product back. So they are non-exchange. So non-exchange in a sense that the entity receives something, you receive something of value. It's like when the government gives donations, when the government receives donations, the donor doesn't necessarily ask for something in return or something that is appropriate. In other words, if I give you a donation of 10 billion and you don't pay me anything, it's a non-exchange. I've provided you money, but for you, I've given me nothing. It could be you can give me 10 billion, but in return, maybe I will pay like 5 billion. Or you want me to first give you the 5 billion so that you can give me the 2 billion. So it depends on the criteria that is there for the either donations, either contribution, because the government may provide maybe farmers through maybe the agricultural fund, all the different schemes that are there. So most of these transactions, they are non-exchange. You receive something of value, or you receive an asset. You can receive the asset in form of cash. They give you the cash to go and buy maybe a machine or to buy land, but you don't necessarily transfer back the equivalent item or service. So you can receive cash or an asset from government, and that entity doesn't pay back directly or approximately equal value, because you can pay, but what you are paying is not necessarily what you received. Like the value is not enough. They have given you 10 billion, the asset of 10 billion, but you are paying back maybe 8. So remember, these exchange transactions are always given. They are in a sense a give and take. They give you and you take, whereby as you receive something, then you pay something. Those are the ones that we call the exchange transaction. As you take the product, or as you consume the service, you pay an equivalent amount. So as you receive something, then you have also to pay something in return to the person. But the payment is always equivalent for the exchange transaction. It is equivalent to what you are taking or what you are receiving. So in most cases, you weigh the value you have paid with the value that you have received to know whether it's worthwhile or not. For example, if let's say you buy a laptop, if I'm buying, let's say I'm buying a laptop, I can look at the functionality of the laptop vis-a-vis the cost they are charging, and we can negotiate. Someone can say, I'm selling you i7, iCore 7, or it is 5, or it is 3, maybe with the hard disk of such and such, the RAM and ROM. So you look at the ROM, that is the storage, the internal storage of the computer. Then the RAM is actually the speed. How fast is it in terms of processing the information? So you can pay basing on the value. You weigh the value of the laptop vis-a-vis the value of the money that you are paying for that particular item to judge whether what they are telling you to pay is worthwhile. And such transactions, they are the ones that we call the exchange transactions. But for the public sector, or in the sense of the non-exchange transactions, most of the times in the public sector, you can hear things like the World Bank has donated maybe 10 billion, or the USAID, the good enough, the USAID is no longer, is not there anymore. As you may find that the USAID has donated maybe 8 billion for maybe child support, Ebola, HIV support. So those kind of donations, but the other party that is donating will not receive anything in return. Of course, we saw a lot of donations coming in, a lot of donations that were made during period of COVID-19, the COVID-19 pandemic. We saw, that's where we saw most of the donations being made. But now you will see that the government has received money, but it is not going to pay back that anything, because the donor may not actually have any request for you to pay back. So the question is, how are we going to determine such assets that we may receive and we are not going to pay back? So that's the role of FSSBES 23, revenues from non-exchange transactions. So this FSSBES 23 will give us the value of how much are we going to attach on such items or such assets, as we shall see. Therefore, the majority of the transactions in the public sector, they are mainly non-exchange in nature. So you will find those, you may find them as expenses, you may find them as revenues. So they may be on either side of the financial statements. So some of the public sector entities provide services, and the users of those services, they have not yet paid, or they are not going to be paying them. So that's what is going to raise the question of how do we value such services. And that's mainly the rationale of having these FSSBES. Otherwise, if such transactions were not there, then we would only use the ISs, because we don't have any IS that deals with such non-exchange transaction, because non-exchange transaction, they don't exist in private sector. Otherwise, if these were not there, then we would go by the ISs and the IFRSs, because that would be, they would be applied. But because these IFRSs and the ISs fall short on what is required in the private sector, then that's the reason as to why these FSSBES were introduced, since majority of the transactions are non-exchange in nature. And these FSSBES, these ISs and the IFRSs can't cater or can't manage them. So we shall cover the FSSBES 23, which is about revenues from non-exchange transactions. And these revenues, they may be taxes. Of course, once the government receives taxes, you don't demand to receive the service for the money that you have paid in taxes. No. That's why they are saying a tax is a non-quid pro quo compulsory payment. You don't receive exactly what you have paid in tax. You can't say, me, I paid 1 million in taxes, so I expect to receive a service of 1 million. Those who didn't actually contribute can actually have more services, because most of the times these service allocations are determined politically. The allocations, you may find that the majority sector, if the political aspects are not fair enough, you may find that the regions that are contributing a lot to the revenues or the taxes are the ones that are receiving the less services than those that are not contributing. So the revenues can be taxes, can be grants, can be donations, can be even forgiveness. You may find that maybe you have, like a country as Uganda, you have a big debt, like as we have. And some of the people where we borrow the money, they can say, for us, we have forgiven you guys because you don't actually have the money to pay. They forgive you. Once you are forgiven, it's going to be an income to you, because otherwise that money would have been paid back. So if, let's say, the IMF, the World Bank, they say, depending on what you guys are going through, we are now forgiving you the debts that you had with us and others. And from here, we shall have what we call the other IPSAS. IPSAS 24. IPSAS 24, which is presentation of budget information. Presentation of budget information in the financial statements. Presentation of budget information in the financial statements. I hope you know that it's mandatory for every public sector entity to prepare and have its budgets. Remember, there is no way you are going to receive money as a public sector entity from the consolidated fund without having a budget. So budget frameworks, budget manuals, they are very important. So it's mandatory for you to prepare and you have these budgets approved, because you can prepare the budget, you submit, and the budget is not approved. So you must prepare the budget, and it's supposed to be approved before you start spending. Before you start spending, you can't, even if money is there is no way you can spend minus, because what are you spending on? These expenditure lines, they are supposed to be approved to confirm that money is supposed to go to those specific things that are within the budget. And that's why once the budget has been approved and you are allowed, because once the budget is approved, you are allowed to start spending. You can't spend on something that is not in the budget. That's why it is very important for you to have the budgets, and these budgets must be approved. So presentation of budget information in the financial statements. So before you start spending in the next financial year, because you know once the financial year is ending, you present your budgets, they approve, then by the time you are starting the financial year, whether the first quarter, you find that you have money to start spending. It's different. It's not like in the private sector. Private sector, you may not even have the budget. You may have the budget, but you don't even follow the budget. So without an approved budget, you can't operate. An entity can't operate anything. Therefore, budget is a major tool in the public sector, which would be actually very, very important and right if they report on it. And that's why we have this FSSBES 24. So the FSSBES 24 is basically reporting on the budgets that we had, that were approved, that we followed when we are executing whatever we have done. That's why in the financial statements, we need to actually report on the budget, because without the budget, there is no way you are going to start operating. So this FSSBES 24 looks at how do we report about the budget in the financial statement. In other words, how do we incorporate the budget into the FSSBES 1, the financial statements? Because FSSBES 1 is a presentation of financial statements, and that's the main role of FSSBES 24. And from there, of course, we shall cover other standards. But for paper 14, we used to have FSSBES 27. FSSBES 27. And this FSSBES 27, it was there in 20, in paper 14, which was all about agriculture. This was agriculture. But it was removed. So we shall not cover this FSSBES 27. The reason as why it was removed, because it is the same as IS 40. Sorry, 41. IS 41. It has no difference. IS 41, that is agriculture. So from here we have FSSBES. We have FSSBES 32, because FSSBES 28, don't want to be skipping some of these. FSSBES 28, FSSBES 28, 29, and FSSBES 30. These were on financial instruments. All of these were removed, and we shall not cover them. FSSBES 28, 29, and FSSBES 30. FSSBES 31, because it is the one we are skipping. FSSBES 31. FSSBES 31 was all about intangible assets. Intangible assets, which was in paper 14. And it was also removed. So it was removed, intangible assets. So from FSSBES 27, we go straight to FSSBES 32, because I've explained 28, 29, and 30, then 31 were all removed. So from FSSBES 27, we go straight to FSSBES 32. Of course, this FSSBES 32 is the one I've been talking about, what we call the service concession arrangement. Service concession concession arrangement. Service concession arrangement, or what we call grantor. Grantor. So that is a new standard that you can't find any IS that is covering service concession arrangement. You can't find any IS or any IFRS. So this is service concession arrangement. And this service concession, this is now something that is not covered in private sector by any standard. But I hope you have heard very many people talking about what we call the PPP. What they call the private public partnership. The PPP, not the other political party, but private public partnership. That's the general term that they call these service concession arrangements. In other words, they're just partnership. It can be a private company partnering with a public company, a public entity, or a public sector entity. Or it could be the public sector entity partnering with the private sector. But the general term is what we call the private public partnership. And of course, we shall pick one of the entities as an example of a private public partnership. And this private public partnership is what we call the service concession arrangement. And this private public partnership is just an arrangement between the government. As I said, it is just an arrangement between the government entity, and a private entity. It is just an arrangement in which, of course, we may have a public entity which we are going to call a government entity. This government entity is the one that we call the grantor. You find that this public or this government entity, or what we call the grantor, has a desire to provide particular services to the public. The initiation is, most of the times, it is coming from the government. The government is initiating, it has a desire to provide some services to the public. But maybe for one reason or the other, they are unable to do so by themselves. And it could be maybe they lack the expertise. It may be accountability by maybe the donor. Because if the donor gives you the money and they expect you to account, there is no way you are going to expect the same person to actually provide the accountability. They may get another person to actually come and try to evaluate what you have done. but they are part of the donor. So it could be the donor setting up the private sector that is going to be looking at the activities that you are doing with the donor fund that they have given you, so that they can be able to account back for the money that you were given. So what will happen is that this public entity or the government entity will get a capable private entity to provide such a service on behalf. And at the end of the day, this public entity will be paying this private entity. Of course, they are paying them for the services they have provided to the public or the society on their behalf, because it would have been their work to provide, but maybe they don't have the expertise to do that. So they hire a capable private sector to actually come and do that. Just like the way you can look at the other Entebbe Express Airways. That express highway, it was constructed by Chinese. They are the ones. It may be a private company because the Chinese are not part of the government. They may have their own company they have constructed. So the question is, how are we going to be paying these people? One of the payment mode could be, let us allow these Chinese to actually collect money from the project that they have constructed. So that's how the other Express Airways comes in. So that's the service concession arrangement. Therefore, how these IPSAS 32, the role of this IPSAS 32, the objective is to help us to be able to account for such an arrangement that we have between the public sector and the private sector. And one of the key things in this standard of IPSAS 32 is the existence of what we call a service concession asset. There must be an asset, just the way you look at the Entebbe Express Highway. You must have an asset. If you don't have the asset, then this is not going to work. And that asset is going to be called the service concession asset. It is the asset that you are constructing upon which they will determine how much you are going to be paid. Because they may not have the money and they tell you, use that asset to pay yourself. But they may regulate that you will charge these people such and such amounts until maybe for 10 years, 20 years, depending on how you have agreed on those different contracts that you may be having. So the key thing in the standard is the existence of a service concession asset. And there must be an asset which the private entity will use to provide the public with the service. You must have an asset which you are going to use to provide the public service. And now the standard gets so much on how to account for such an asset in the service concession arrangement. In other words, it guides on how do we account for such an asset, because sometimes it's actually the private entity that is going to be considered. For example, if let's say we assume that it is, let's say, Ministry of Health, and maybe they want to construct a hospital, let's say in the northern Uganda, they may contract one of the private hospitals to actually go and construct a hospital, they start providing the services the government would have provided. Then later on, they will agree on how they are going to be paid. They can allow them to operate the hospital on their behalf so that they recover the money they have put in the construction of the hospital. But the bottom line is that there must be an asset. In other words, the hospital is there. That is the service concession asset within the arrangement. It's upon which these services that we want to provide to the public are going to come from. So, if they want to do so, they can say that let's hire a capable person and maybe we'll give them a contract of 20 years. They be the ones that collecting money from that hospital to cover the cost they incurred to construct that hospital. And after 20 years, they will leave the hospital, they will leave the facility to us. But within that, they must regulate the pricing. You shouldn't overcharge. They should provide at the same price the government would have provided to the people. They have also to look at the maintenance of that asset. Because if you don't tell someone that you are going to maintain this asset for the period that you are in, so that by the time when your period is done, after 20 years, we need the asset to be looking like this. Because if you don't do that, then the other person will just pick the money and don't do the private public partnership. We should have a concession, a service concession asset, so that the person that is going to construct maybe the hospital will manage that hospital for maybe 20 years, and by default, since these guys ought to finance the construction of the hospital, they should manage it for some years, depending on the contract that we have signed with the person or with the company. But now, what is going to be key is the fact that even though this is a private public partnership, even though it's a private public partnership, we are going to have items. I've said one, that we need to have a service concession asset. But now what is going to happen is that this service concession asset will be reported in the books of Ministry of Health, even though it was constructed by the private party. But remember, this asset, it belongs to the government, belongs to the public entity that gave out the contract to the private person. So this entity, this service concession asset, if it is in the financial statements of the Ministry of Health as their asset, it's an asset of the Ministry of Health, even though it has been constructed by a public entity. So once you look at the financial statements, this asset will be reported in the financial statements of the ministry as their asset. And the ministry is going to account for that asset in their books as if it is their own asset. So the question will be, how do we treat or how do we account for such an asset that is covered under the IPSAS 32? Because this asset, it is accounted in the Ministry of Health, but it was constructed by the private entity. So we need to know which figures, because yes, we have understood we are going to account it in the Ministry of Finance, but which figures are you going to assign? Because you may have a contract with a partner to actually construct a hospital, and you have not even prepared any amount that you are going to pay to them, but you have arguments that you will allow them to manage the hospital for a given period of time so that they be recovering their own money. But what is key is for you to make sure that you regulate the pricing. It's not them to set the price they wish. Because the intention of constructing the hospital was to provide public services, health services to the people, and it should be provided at a price being provided by the private hospitals. So that is very key. However, in the old syllabus of paper 14, in the paper standards, the other standard that we used to have IPSAS, the consolidation statements. The IPSAS 34 is all about consolidation, IPSAS 35, and IPSAS 36. We no longer have these standards. So, because we no longer have to consolidate in this new syllabus of paper 13. So, that is all that we can talk about as far as standards are concerned. And that's what we are going to be dealing with at the moment. And if you have any question for what we have talked about as far as the standards are concerned, please make sure you put those comments in the comment section. Understand these standards. Remember, we are just analyzing the course outline. We are doing a detailed analysis of the course. The course contents. We are looking at the different topics that we are going to be looking at. Remember, we had a change in the syllabus, but there are some past paper numbers that are still reflecting the paper 14. So we want to just be able to clarify some of the issues before we start our journey, or before we dive into the series that we are going to be looking at. Now, before we start papers, we try to know more about the past papers. Especially the old past papers, past paper clarification. Past paper clarifications for all the syllabus. What are we going to do? I want to make sure that I highlight on some of the things in regards to the old past papers of paper 14, because someone may be wondering how can I be able to utilize the past papers of the old syllabus without reading a lot of irrelevant. You may be there reading past papers, but you're just reading things that are out of the syllabus. Because we've looked at some of the topics that were removed, we have looked at the standards that were removed from the new syllabus. Just get those numbers that were removed from the syllabus, especially the standards. You also ignore them as you are doing your revision. Like questions to do with the consolidation, those ones you ignore. And other standards, of course, other standards that were removed. But other information of let's say the current they are going to be relevant, so you never drop them as you are revising. So specifically the consolidation and the other standards that we are taken off or that we are removed. To understand that they have actually added some other materials. So those past papers, they are still very relevant. So we will only ignore those ipsases that were dropped off. Those are the ones that we can ignore their numbers. Like I said, for those ipsases on consolidation of financial statements, as we saw them, but other information which basically the theoretical aspects, they are still available and they are still relevant. We shall see them as we proceed. So most of the theoretical things that were removed, other than the standards, because we needed to be very specific on the standards that are still relevant. We say they are 10, but I've added some of the likes of the inventory, the likes of the impairment exchange, I think. No, we added impairment of non-cash generating assets. So the rest of the things that we shall see or we shall come across, I'll talk about them as we proceed. But what I wanted to put more emphasis or to comment more about are the past papers and then the standards that were removed. And we have been able to highlight that some standards were removed, but they are important. You can find it in an exam. Some were removed as a matter of fact that they are covered. So I want us to, we have now finalized I want us to look at another topic that is going to basically look at the accounting practices and bases. Just be reminded that here we are basically talking about we are just looking at the course outline. We are analyzing it. We have not yet started not had me explaining what a public sector entity is. You have not heard me talking about the academic aspects or the academic environment of the public sector, the examples of the different public sector entity, putting them in the context of the academic environment. So we are just analyzing, and that's why I called it the introduction, because we have some amendments that were made in the syllabus, and they are very important for you to understand them before we dive into the series. So we are going to look at as the accounting practices and bases. Once we have analyzed that, we shall look at the next topic until we finalize with the course outline as given the course syllabus. I gave you the websites. Even when you don't have access to the, you can just type in Kafero Charles in Google. You go to Google, type in Kafero Charles, you'll be able to see that link, or you can use www.kaferocharles.com, or you can use our main school, which is KC Accountancy Education Center.kaferocharles.com. Once you go there, you'll be able to download these are the websites. We have uploaded past papers, we have uploaded very many materials you can check out. So let's meet in the next videos. We are talking about the next topic of accounting practices and accounting bases.